So as per usual, we're going to go through three things: where we've been, where we are, and where we might be going. We're going to offer some thoughts about what might be happening, and then we'll mention briefly some of the steps we're taking inside portfolios near the very end, so that you guys know what's going on there as well. All right, I'm actually going to be quiet for a minute and let Scott pop in and do where we've been, and I'll come back for the middle section.
So yeah, I'm not having technical difficulties, but I'm definitely having feline difficulties. So if Kaplan makes an appearance, just bear with me over here. But let's talk about the great reopening. It's been about 16, 17 months since this all started. We're all glad we're here to talk about it. And obviously vaccines have been a big piece of why this has all happened. A year or so ago, we didn't know these were coming. We were hoping for them to come, and here they are. So let's dive in a little bit. You may remember, this is back in like January or February. There were about 250,000 cases at its peak of COVID in this country, which was pretty scary at the time. We're now down to about 12,500 per day, which is light years difference. And there's only one thing you could point to that's causing that, and that's the rollout of the vaccines. I do want to point out, though, we are a global economy. And although we're doing really well here with vaccinations, you see the bright blue, that's not the case. Africa's got a ton of work to do. The northern part of South America has a lot of work to do. Parts of Europe we're all hearing about still has work to do. And so until that happens, commerce and tourism can't really ramp up until this country and the rest of the world really gets vaccinated a whole lot more. We've made a tremendous amount of progress, as you can see by the dark blue, throughout the country and the world. So, per usual, I think in this country, we get creative sometimes. So I don't know if you've heard of some of this stuff. When I started hearing about it, I almost wasn't believing it, but they've got all sorts of things going on to motivate people to get vaccinations. They're giving out free donuts, which would get me excited. They're having all sorts of lottery drawings. They're giving out Super Bowl tickets, Major League Baseball tickets, paid time off, and a whole bunch of other things. We couldn't list it all here. So we're doing what we can to get there. And again, we're making a ton of progress, but we still have quite a bit of work to do. So let's talk about the markets a little bit and what's gone on. Now, again, this is a very small case study in that it's only year to date, right? So year to date is just January to basically the end of June. Very small picture of time relative to the long term, but we're talking about kind of where we've been, and let's get a sense for what that looks like. So it's really clear what's happened globally. I mean, with the exception of China and the Far East, as you notice down here at the bottom or in the middle here, most of the globe, the world itself, 12.2, US 14.1, the frontier markets, emerging markets, UK and EU, tremendous amounts of rates of return in just a very short period of time. And so the global economy is working, the global economy is expanding, and people are getting much, much more optimistic than they were just a year or so ago. So really clear what's happening here, even though the media and whatever, periodical, NPR, CNBC, TMZ, whatever you're listening and looking at, even though they're always going to tell you the sky's falling and things aren't great out there, if they're not recognizing that we're in a ripping, raging bull market, not just in stocks in the stock market, but art and cryptocurrency and memorabilia and autographs and anything and everything, assets are inflating. And anyone who's not seeing that, I don't think they're paying attention. So just really clear here, the globe is working, and year-to-date performance has been tremendous. This is really interesting. This is pointing to, if you recall, when the vaccine actually was announced and kind of rolled out back in November. And this is talking about, like, I guess, the November 9th or so of 20, when this all happened. And there was a huge shift in leadership. Now, most people on this call have had conversations with John or myself or John Madden or David or any of the wealth advisors and planners. And we know that small outperforms large over long periods of time. We know value outperforms growth over long periods of time. But that actually hasn't worked for a number of years now. What's happened literally since November and the sort of vaccine day rally that we've seen is it's actually coming to start working out again. And so you'll notice here what's happened in small versus let's see here, value versus growth, tremendous outperformance. Look at small versus large, same thing. So this is not a picture of time that we want to extrapolate too much from, but clearly the last half a year, small and value have started to work and work in a meaningful way. Value stocks are stronger than growth these days, and doesn't mean it's a permanent condition, but it's just something we wanted to talk about as we talk about what's going on. This is a long kind of quote from Aziza Kazimov. Let's just speak to what they're talking about here. So there were about 40 companies, 3 or 4 dozen companies that announced they were suspending their dividend last year for a whole bunch of obvious reasons. The good news is many of these companies, about a dozen, have now actually reinstated those dividends. And they're going to fall in that kind of cyclical bucket of stocks. And the largest beneficiaries of the economy and the economic recovery that we're experiencing now are those kinds of companies. And I think we think we'll see more and more of that coming online. The banks have announced a lot of big stuff as well in that regard. So let's just dive in a little bit here with earnings and what's happened here. You may have seen this also all over the news. Earnings recovered in just such a whopper of a number, 52.9% earnings recovery, which is just a staggering number. When the estimates initially were only about half that. Almost 90% of companies are actually coming in above earnings estimates. Again, getting back to what I said earlier, we're in a roaring bull market. There are still some companies that are struggling, but by and large, on the margin, I mean, companies are really doing extremely well across the board in a lot of ways. So we're really coming out of this, is going to be titled, if you've heard it before, the shortest recession in the history of recessions after what happened with COVID. That's what's going on. We had a horrific drop of 30-40% in about 28 days back in March of 20. And in order for you to recover from that, you have to have a ferocious recovery. That's exactly what we had. We didn't anticipate it to be as fast as it did and had, and a lot of people hadn't as well. But that's why you stay fully invested. You can't predict that stuff.
So one quick thing to add here is there's a lot of conversation you're going to hear right now, and we're actually going to talk about a little bit later about valuations. Mm-hmm. And one of the things that's so difficult about valuations and about looking at valuations is when you look forward at the beginning of the year and you expect earnings growth to be about 23.7%, and you build your portfolio based on an expectation of 23.7% of earnings growth, and it comes in at 53% of earnings growth, suddenly you are undervalued. And so what the market is doing, it's discounting this belief that our earnings are going to be higher than the analysts are expecting. So the market is saying, you know what, analysts are, they're sandbagging. They're sandbagging.
Yeah.
Yeah, they're very conservative.
Very conservative. I don't think this slide's a big secret. We've had a tremendous amount of stimulus poured into the economy in the last year or so. 5.3 trillion to be exact so far. The American Jobs Plan everyone's heard of, the Families Plan as well. It's hard for markets with this kind of flush in inputs of capital into the system. It's hard for markets to suffer. It's sort of putting in a net. Same thing happened in 2008. A backstop was put in, and although it was uncomfortable, it put in a floor, and the markets, once they settled in, went back to all-time new highs, which is exactly what's happened, in the last 16 months. So huge stimulus, probably more to come. You'll hear about it in the news, but this is a tremendous amount of capital that's in the system now that was not here just a year and a half ago. A lot of money floating around. I think us leaving this slide out would have been a mistake because there's a ton of speculation. And that's what happens in bull markets. So you've got the meme stock popularity, whether it's GameStop or names like GameStop, sort of hard to deny what's happening there. Lots of questionable cryptocurrencies. Maybe the Bitcoins and the Ethereums work and they become, commonplace in the future. But there's, I think I saw a number like 9,000 now out there. That's how crazy it's gotten. And there's just a tremendous amount of extreme share price valuations that are going on. Just take a look at what's happened to the SPAC market. And there's in this chart to the right, that market in terms of millions is what they're using here. Look what was going on in 2010, 11, 12, and 13. Look what's happening now. So when you have cheap money and it's flooding the system like it has, for better or worse, it creates speculation. And there's a lot of cheap money floating around. And so that's what's going on here. So you got to be careful. It's a lot of get quick rich kind of things going on. So you got to, stick to your knitting and stick to your plan, et cetera, et cetera. There's a question coming in that says, what is SPACE? I think you meant to say, what is SPAC?
Special Acquisition Company.
Yeah.
Special Purpose Acquisition Company.
Yeah. And so what these companies have done, they're kind of blank check companies. They're kind of like a shell company that a company that wants to go public comes and gets attached to them, and they go public not through the traditional means. And there's been a lot of that going on. It started out really exciting. People were making a lot of money, and then it came to a screeching halt. People are losing a ton of money. And it's just that classic example of the next shiny thing. You got to be really careful with this stuff. Virgin Galactic was, I think, brought public by a SPAC. and it flew to the moon, no pun intended, and it crashed to earth pretty quickly.
So we have a few written commentaries on SPACs and the SPAC market that are on the blog, and we're happy to forward them to somebody that wants them. I think the fundamental is it's not in the favor of the investor to use these vehicles unless you're a founder. If you start a SPAC, you're going to make a ton of money, regardless of whether the company is successful or not. So that's enough reason for us to steer clear of these entirely. I feel the same way about most IPOs, but SPACs are definitely not in our favor.
And so treasury yields and the treasury market has been an interesting place. You may recall in the middle of COVID, I can't exactly tell from this chart. I believe we were down around 0.5. So 50 basis points, meaning if you hold a 10-year piece of paper issued by the US government, they were going to give you a whopping 0.5% interest for 10 years to do that. That's how low rates were. Now, there's a silver lining in all of that. A lot of the folks on this call, I'm sure, refinanced their mortgage, right? So when rates come down this low, there's an equal and opposite reaction in that refi market. We've done this with a ton of families, and it's been a huge beneficiary to their plans, obviously. Unfortunately, checking, savings, CDs, and bond rates and yields are a pittance at best. But it's been very volatile, and the reason why it's sort of rallied recently and come back down again is there's a lot of uncertainty in the bond market about what's coming. There's a lot of talk about what inflation means. Is it transitory? Is it going to stay for a while? And the treasury markets usually, get a little choppy when that kind of thing is happening. And this shouldn't be a big secret either to anyone on this call. And it's not just a Bay Area thing. Home sales went through the roof all over the country. Areas like South Dakota, like Phoenix, I mean, places that normally don't go bananas have officially gone bananas. Austin, Denver. It's been pretty incredible what's happening in real estate. Existing home sales, huge number, up almost 50%. Median price for a home, $350,000. I think that's the highest level ever, or real close to ever. And the increase in price, over 23%. So there's still not enough homes going around. We don't believe this thing ends tomorrow. At some point, things have to slow down, but we don't believe it's portending some big crash, even though everyone's predicting one. And we're not in the prediction business, we're in the planning business, as you all know. That's housing.
It's the one thing. There's two things actually. One, the difference between today and 2007, 2008 is there isn't free money that there was in 2007, 2008. That's the first difference. And the second difference is there's an entire generation of home buyers that no one's built anything for. And so there's simply not enough housing. There's not enough housing out there. And so the housing has to be built. The home builders are just on a tear right now, even though the price of lumber is so high. But home builders are on a tear because they have to build madly to keep up with demand. And that's actually real demand. And that's why Scott said it. We don't think it's a bubble or anything like that. But again, we can't predict. The one thing my parents asked me to say when I was going to talk about this is Californians need to stop moving to South Dakota. People are buying cash, putting cash down. They're selling their house in California and buying a home for cash, and they're driving up real estate prices, and they're driving up the property taxes. And my parents are angry with us, so stop it, and they'll appreciate that.